if your mind is not sound, you will make for a terrible investor. If you have yourself grounded in not just proper investing principles, but in understanding yourself, knowing how you behave in certain stressful situations.
Because the AI knows so much about you, it would literally just be buying stuff for you. You won't even have to think about it.
When something works, do more of it. When it doesn't, stop doing it. Sounds simple. Most can't do it. This is straight out of the behavioral psych.
At some point, like a major company is going to have a major breach or failure or ransomware or something will happen, and it will be tied very directly to their adoption of AI instead of like robust cybersecurity. And I think it'll be something like that that's going to be like the wake-up call for the companies that perhaps went a bit too far down that path. For an advertising-free version of this show, check out wallstreetwildlife.com. Welcome to the Deep Investing Jungle with your hosts Luke the Badger Hallard and Christoph the Monkey. This week, Claude Code rattles cybersecurity. What has George Kurtz got to say about it? Plus, the rise of zero-click commerce. Christoph has got a ton of investing wisdom for us straight from TheProfInvestor. Plus, he's taken us on safari with Nektar Therapeutics.
Badge, one, you're still alive. Thanks. There were avalanches like that killed people, and you're all nonchalant. Every time I said don't die, and you're like yeah, and then next thing I know, 3 hours later, I get news like 9 skiers dead, 10 minutes from where you are.
Yeah, no, it's pretty sad actually. Yeah, like it's hit the community in the sort of area I'm in. But yeah, not pretty. But I thought skiing, and particularly backcountry skiing, is a dangerous sport, and so stuff does happen.
Yeah, don't let stuff happen to you, please. Because then what will happen to our podcast? It's going to degenerate into like day trading using 5-minute charts.
It'll be like all options and all like biotech madness. So yeah, maybe there's definitely an audience in that system.
Yeah, it'll be complete disaster. Oh, don't die. That's the basic point. I have spent all of last week, as you know, post-releasing Options University into the wild. I've returned to the developer's dungeon, just continuing to plug away at all the, issues that come up when something is live. Thanks to a few of our intrepid Patreons who have been going through the course and telling me what's great and what's not working, I've been able to fix quite a bunch of stuff. I also did a major restructuring, which broke a bunch of links temporarily, got that fixed. But all in all, it's progressing, I think, quite nicely. There's a working mobile app now that's basically a duplicate of the desktop that I was quite satisfied at having been able to port over. So on my end, Badge, I've been between my usual teaching duties and then using every spare moment in the developers lab. It's been quite a intense past week.
It's pretty, like what you've built is really good. I tested it on Android for you, or at least I clicked through a bunch of screens. Seems to work. So thank you for looking after us wiser Android owners with your app.
Awesome. Very good. I guess public service announcement is that in order to support people who are ready to learn about options and how to add that toolkit to their portfolios, both in terms of the aggressive leverage that it enables, but also as risk management and to prepare for volatile times and potentially big market downtrends, I decided that for now I'm going to show up for office hours weekly, definitely on Friday afternoons, 2 p.m. Austin, and then probably also on Saturday afternoons, depending on scheduling. But if you are interested, then open up the course, start learning things, and I'm there to support you and to answer questions. And all of this can be coordinated on our Patreon at patreon.com/wallstreetwildlife.
Awesome. Are office hours a Patreon exclusive, or can anyone join up?
Yeah, so for the way I envision it is I do not want to create a toxic sludge of, strangers and, God knows who might show up. And so in the end, it will be for Patreon subscribers. But for now, I'm welcoming all beasties who are curious about options and or somewhere in their journey where they could use a little support. I think that's the right thing to do, right? Just not exclude anyone at the start and then kind of tighten in the fence as we go.
Yeah. Hey, you reminded me actually, we got our first, I didn't even see it because you were on top of it. We got our first scammer or troll on the Patreon.
We made it.
Yeah. So that's it. We've made it. Once you start getting attacked by bots, you're legit because, you got enough scale. What was this person doing? They were trying to give away a MacBook or something.
Yeah. Monkey immediately took out his phone and started out. I was like, I need a MacBook. Only to end up, at an unsavory OnlyFans page. I was like, hey, wait a second. Oh, so Madge, you too have been getting deeper into the Claude coding world and everything it's enabled. Obviously, we have Beaver running, who also got, I think, a lobotomy over the last 2 days when I wasn't looking. Tell us about your shenanigans.
Yeah, so you got me playing with anti-gravity, and I've kind of switched over to Claude Code in the last few days, just because I'm finding it a bit easier to use, frankly. I'm a bit befuddled by anti-gravity. I'm on ski season with a bunch of friends, and one of them has a very successful online business around coaching, mental health care, well-being. And she'd been thinking for some time about building an app. So we were chewing the fat over a glass of wine a few days ago. And I'm like, well, I'm doing this agentic development stuff. Let's see if we can throw something together. And in a day, literally yesterday, with Claude Code, and I have now jumped on the bandwagon and bought a Claude Code Max subscription just so I could play with it properly. We built a very solid prototype of an app that she thinks she could scale pretty easily to a 5-figure per month income. So that's a lot of return on investment for $100 coding subscription.
Yeah, completely agree. I'm fascinated by this, because of my work in the therapeutic world, also in the Zen world. And I'm also sort of blueprinting something in the background that kind of ties in a little bit with investing know-how, because I wasn't expecting to go on this tangent, but you and I would agree, right, that fundamentally, if your mind is not sound, you will make for a terrible investor. If you have yourself grounded in not just proper investing principles, but in understanding yourself, knowing how you behave in certain stressful situations, you will avoid some of the more catastrophic errors. So these two worlds are not actually, far apart. I mean, there's degrees and stuff, but I'm looking forward to developing this more also.
Yeah, so we were chatting over dinner last night because a couple of the other guys in the house were like, oh, what have you guys been jabbering about in the corner? So we showed them what we built. And my comment over dinner last night was this technology, none of this stuff is the roadblock now. The roadblock is just having a good idea and having a vision as to what this thing you want to create should do, the value it should add. And if you've got a good idea, my buddy has already got an established business. She's got very significant reach on Instagram. So she's already got this marketing engine set up. So she thinks she could scale this thing really quickly. But, you and your options university, there's a ton of people out there who are going to want to learn at some point in their investing career how to use options responsibly. And, you've been able to build a resource that's going to help them do that. So there's potentially big audience for kind of any idea, really.
Yeah, it really feels, it feels, this is trite to say, but I was shocked at the moment when maybe it was early November. If I think back, when you could feel there was the new, you know what it was, actually thinking out loud? As you and I were playing with, say, image generators now for over a year, designing Wall Street wildlife logos and coming up with avatars. But, anytime you wanted text in the slide, it would come out all garbled. And then something happened early November, right? Where all of a sudden that problem was fixed. So November, December, January, end of February. So it's now been 4 months that I've been doing nothing but this stuff. And it does seem like floodgate, to your point, it's now just about putting your head down and working as long as you have an idea, but everything seems possible. It's exciting, exhausting and exciting.
We've got a few topics on the docket for today's conversation that do sit in this space. I wonder if we should just jump into the first one, because
let's do it.
I've been rattling on for probably a year now about the impact of AI on technology companies, and now we're seeing the SaaS apocalypse. But I've always said for quite a long time reasons why I feel cybersecurity will be immune from this. Well, right now, it ain't immune from this. A whole bunch of cybersecurity leaders like CrowdStrike, Palo Alto Networks, Zscaler, and their peers, they're all getting sold off. And the news that triggered that was literally just a blog post from Anthropic CEO Dario Amodei a few days ago. Talking about Claude code security, which is now scanning GitHub repositories like code that's out in the wild, looking for flaws, defects, exploits in open source projects. So suddenly, the cybersecurity world went, holy Christ, because there are companies that do specifically that, and those companies just got wiped out by, a native capability of Claude code. I still do not fear for my cybersecurity stocks. I do not fear for my cybersecurity stocks, even though you can see Palo Alto Networks and CrowdStrike, both good chunky parts of my portfolio, they have both sold off pretty hard, nearly 35% in the last 2 or 3 months. I don't fear for them. And George Kurtz, CrowdStrike CEO, posted, I think, a pertinent tweet just yesterday. Kurtz was basically saying, it's kind of an off-the-cuff remark, can AI replace cybersecurity platforms? And then, he just asked a small question to Claude, wherein Claude said, no, I can't do this. I can't replace CrowdStrike. That's not the point. But I think the point of George's post is his last paragraph. If you want to create AI, you need GPUs. If you want to deploy AI, you need security. That's not a hallucination, it's a fact. You could be out there building the options university, and I'm building some therapeutic app for my mate. If you want to deploy these things safely, you need to have security built in. These are not mission critical bits of software. It's not like you'll be doing real options trading in the options university. It's more like learning and journaling and things like that. But if we're sort of vibe coding stuff, that's not enterprise grade software. And enterprises, banks and big institutions that have real customer data and could end up in the courts of law if something bad goes wrong with that data. They got to take this stuff seriously. They can't just kind of outsource it to a bunch of vibe coding engineers.
I really like this point. This is this sounds similar, Badge, to what you were saying about Google. Some months ago, there's the panic about them losing all the ad spending, but your understanding reframed it as an opportunity rather than a existential threat. I would love to get back into a company like CrowdStrike, these lower valuations, and I think I'm buying your argument You know what's making it a little more convincing to me? It's the enterprise grade stuff, the deep roots embedded in the company. You just can't add a superficial, maybe for like, put it this way, maybe for like solo, for small teams, right? Small old mom and pop shops. Okay, why go with CrowdStrike when your thing is going to be pretty darn good? But the moment you get into conglomerates, no way, right? Same thesis I have actually for UiPath at the moment. So, that stock is beaten down, same existential threat, but the thesis there is for companies that have deep embeddedness, who need orchestration. Your little local things just ain't gonna cut it. Question for you then. What do you think, when do you think might we have proof of, say, survivorship for these cybersecurity companies? Is it going to be on a next earnings call or 2 earnings calls from now where, see, actually, as I say that, I'm going to self-correct. We know like the earnings potential is still going to be strong. That's not the issue, right? Adobe and the other ones that we think we're bearish on, their numbers are still going in the right direction. It's just that we're saying the market's going to discount future cash flows, 3 years from now, 2 years from now. When do you think it'll be, I don't know how to say, safer to know what the outcome of this will be?
I think here's like an analogy. Do you remember, was it Klarna or some company? They said, oh, we're getting rid of all of our call center operatives, thousands of people, and we're replacing them with AI. And then like a few months later, I think that was kind of unwound and they kind of rehired everybody, or at least, their plan got waylaid. I think it's going to be something like that, because like companies are using sort of these hyper modern development techniques now much more, and getting efficiencies and everything else. And at some point, like a major company is going to have a major breach or failure or ransomware, or something will happen, and it will be tied very directly to their adoption of AI instead of like robust cybersecurity. And I think it'll be something like that that's going to be like the wake up call for the companies that perhaps went a bit too far down that path, and frankly tried to save money, because that's that is the responsibility of the board of a company, is to maximize shareholder value by increasing revenues and decreasing costs and investing in the right things. If a company goes a bit too far with like a bit of a punchy CTO, like technology officer, who goes, oh, we can build all of this like safety and security stuff with AI, and then they suffer the consequences, then that's probably the thing that will cause our cybersecurity stocks to rebound. I don't know when that'll happen, but it will happen for sure.
Yeah, interesting. So maybe a task I'm going to assign to myself is, if I layer the technicals onto the thesis, the technicals are continuing to be in a downward sell-off. Timing this well will prove lucrative. Like timing trying to time the inflection point, if you're right, which I think you are. In this moment, it seems like more patience is warranted. Like I wouldn't go too heavy yet. And meanwhile, I mean, I don't know, if you have a position already, then it might be a good opportunity to dollar cost average, assuming that there's obviously lower that it could go. So, I mean, to be determined, but I'll definitely talk about that a little more. But I have these companies like Zscaler and CrowdStrike high on my watch list.
Yeah, great. And I mean, I am a massive bull on AI. I'm just kind of pointing out why I think this one little niche, cybersecurity, is going to be AI resistant. But at the same time, like we're now seeing real numbers from the hyperscalers, from big companies, that tell us like this stuff is real and it's making a huge difference to the industry. Like, only at the start of this month, a couple of weeks ago, Alphabet They're now doing over $400 billion in revenue. So that's massive. And at the same time, their costs to serve Gemini, like their AI platform, are down 78% year over year in model optimizations. And at the same time, their cloud backlog has more than doubled to $240 billion. Like they did this code red when ChatGPT seemed to be like stealing market share, and there was this, all this narrative around search is dead. Like one of the founders stepped back in, like they have responded effectively. This stuff is real.
Yeah, and that reminds me too that from my portfolio's position, the more I see all of this, the more I realize that those fundamental layers on which drive AI, namely electrons, and also you could add water to that, those very basic requirements, and obviously in EOS batteries, I can't foresee a world where that bottleneck is resolved anytime soon. Right? I mean, because this is just starting. So I guess a note to our listeners, if you have not yet done your due diligence about Iron and Cypher and EOS, and well, I also have two little smaller market cap data center plays in my King of the Jungle portfolio, DigiPower X and Solana. Risky, but if the thesis is correct, then this is just starting.
Well, should we? I've got some more AI stuff to talk about, but maybe we should kind of break from that topic for a little bit. Have you got some investing wisdom for us?
Have I ever, Badge? One of the ways I like using X the most is finding other investors who have a good, strong track record. And I came across TheProfInvestor on X. And this guy is quite similar to what I'm trying to do. He has both a long-term portfolio that he more or less doesn't touch, and then there are the Googles and Amazons and Teslas. And he's simultaneously using the charts and doing shorter-term momentum stuff in a whole different portfolio. And I think that's the proper structure. I talk about this all the time, as long as you don't confuse yourself. And he comes out with regular, I think, good investing insights and wisdom. And this list that that we're going to share, I thought there's a bunch of ideas here that we could go through and see whether we agree, disagree, how we would amend them. We don't have to go through all of them, but there's plenty here. So just one by one, to refresh your memories about good investing hygiene. When insiders buy, you pay attention. What do you think of that, Badge?
I think it's a signal. Like, I think people perhaps put too much focus on insider transactions. And I typically ignore insiders selling because we're all human. You need money. You want to buy your next mega yacht or move house or pay for a divorce, right? There's good reasons why you might sell stock. You're right. When insiders buy, that is more impactful. Like they're putting more of their wealth into the company. But at the same time, like I'm not a fan of like if someone's like a billionaire and they buy, $10 million of stock, that's just not relevant to me. Like that's not meaningful.
To me, it's an important signal. And it's not the end all and be all, but I really like when that happens. When stock gets below 200-week moving average, you avoid. And that is, straight from the technical world. And all that means really is that over the last 200, usually days, there's an average at which the stock traded. And if your current stock is below that average, that means the sellers are winning. And so they're selling for a reason. And so if they're selling for a reason and you're buying, from my experience, it's usually out of an idea that, well, now it is really cheap and I'm getting a really good deal. But more often than not, what you see, unfortunately, is that momentum just continues. Both in both directions. The down continue to go down and the up continue to go up. So it's kind of a simple heuristic to check this one number. Are you going with the trend or against it? And if you're going against it, you should know why. Similar in alignment to that is when he says, if it's down 50% in the bull market, there's a reason, and it's not opportunity. And I think that too is a very common mistake. We could look at a bunch of scorecards where we know the market is near all-time highs, but the stocks are down 20%, 30%, 60%. Well, how is that? If the if the market is gallivanting and you're picking stocks that are losing to the market so badly, what's the reason for that?
Yeah, like often stocks are down for a reason. And, if a stock is up, if the whole market is up, like more often than not in the short term, like stocks typically just kind of move with the market unless there's some real like narrative breaking thing has happened. But if a stock is down like by half in a market where most of its peers are rising, like there's probably a reason why it's broken. And I think to lean on stuff you've been saying very clearly, like you can be a contrarian. Like if we go back to your words of like 2 years ago, in some ways the only way to like generate alpha is to be a contrarian. But you got to know why you're being contrarian. You got to know why that stock is down, and you got to believe truly that you are smarter than the market because like it's selling off for a reason.
Which, by the way, is maybe this is counter to what I said in previous episodes. It's still doable. To Exhibit A, we just talked about your thesis around Google. In no way a company that is under anybody's radar. You just had a very clear understanding of what was happening, and that contradicted what even a majority of the talking heads were saying, right? And you were, by the way, I remember our conversations around this. You were not wishy-washy about it. You were pretty confident. Of course, you could have been wrong, theoretically, right? You weren't wrong, but you could have been. But you were contrarian, and it didn't take some secret corner of the internet to get to that view. Simultaneously, in biotech, that opportunity exists all the time because few analysts are actually understanding whatever biomechanism that only scientists truly know. So that's an area of alpha that comes up repeatedly, and also in small caps usually because it's easier to be a contrarian because nobody really knows about the company yet until they've done their research. I really like this one, Badge. If you can't explain the thesis in 2 sentences, you don't have one. You have FOMO.
Yeah, that's good. And they got to be like simple. Explain it like I'm 5 sentences. You can't have like 2 sentences of biotech gobbledygook. Right? My version of this is like, can I explain it to my mum? And if I can do that, then like I understand the company.
Yeah, and it's kind of shocking how few people could actually do this.
Right.
I mean, in simplicity lies deep understanding, but I'm sorry to say, I would venture more than half of all people who own companies probably could not explain their ownership beyond some like, well, so-and-so liked it, or, it's up, or, I mean, metrics that have nothing to do with that deep understanding of this is why this business will be successful over time. And yeah, it's an easy fix, but human nature, right?
Yeah.
Let's do one more.
And actually, I mean, just on that, right? Here's like an actionable thing for listeners. Just go read through your portfolio and just go down the list, like top to bottom, and say, what are the 2 sentences? What is like if you're explaining this to someone who didn't understand what the company was, and, if you can't explain it, be honest with yourself, then probably shouldn't own it, or at least go figure it out.
go figure out what the business you own does. And something that can come out of that exercise too is your thesis might reveal itself to be thin, and you might actually realize that you don't believe it's strong enough to own. So that's important.
That's a great point, because there's a counter to this as well. Like, really, if you're going to go to the next step, not only should you be able to explain what the business does in 2 sentences, you should be able to explain what the bear case is, what could go wrong, because you've got to understand that too, right? And face into the reality that you might have it wrong, because you're not going to be right every time.
That's right. And we talked about this in last week's episode, which I thought was a great episode. You should listen to it when we did the portfolio review. It's easy to say, I own this company like Adobe because it's a powerful software and my friends still use it and so on and so forth, and completely avoid the elephant in the room that, yes, and people still used film cameras once digital cameras showed up, but that didn't end well for the film cameras. Let's do one more. When something works, do more of it. When it doesn't, stop doing it. Sounds simple. Most can't do it. This is straight out of the behavioral psych. And, speaking for myself, you and I both, but because we've made all the errors there are to make across the decades, it is a little bit frustrating that even sometimes if you recognize I've made an error in this particular way, to generally change your habitual default takes practice, it takes training, it takes repeated reps using a tool like a trading journal, which, by the way, as you know, I've made a core functionality in my Options University course, because it forces you to slow down and say, I made this trade, it did not work, here's why. I didn't have enough of a thesis, or I was going against the trend, or whatever.
It's particularly hard as an investor because, I always draw parallels between investing and the game of poker. In the game of poker, like, you get to make a lot of decisions. Let's say you're playing online, you might, in a session of maybe 4 or 5 hours, you might have like 100 quite meaningful decisions. And if you're playing live over the course of, say, a 5-hour session, you might get like 3 or 4 quite meaningful decisions that really like define your night. Well, over like an investing career of, like, say 20 years, I don't know, maybe I've made like 10 really impactful decisions over that time, and the rest is kind of noise. I don't know which are the big decisions ahead of time. So because there's so few opportunities to actually judge whether you're making good decisions or not, and it takes so long to know whether your thesis was right or not, like, it's critical to reflect, to have a process, have a journal, and be honest with yourself. If you made like a ton of money on some random shitco, if you've made a load of money on quantum computing, I'm going to stick the boot in again. I love getting into this sector. If you've made a ton of money on quantum computing, like, great, well done. But in my view, that does not make you a successful long-term investor. Like, you're jumping on like the latest meme trend without really understanding it.
All right, Badge. Check out TheProfInvestor. He's a good follow across the different styles in the market. So hope that's useful. Can we get back to the world of AI? You want to tell us a little bit about what's happening with Shopify and commerce and the e-commerce platform wars. What are you seeing out there?
I think I can link this into what we were just saying, actually, interestingly, because like Shopify was one of my material decisions. I started the position in 2016, I think, maybe late 2015, and I was an owner through to 2023 or 4. And that was like the engine room of my portfolio. That generated the large majority of my investment returns and drove my market beating compound annual growth rate for that 7 or 8 years. But I got out of Shopify when they kind of flip-flopped on logistics. If you don't know who Shopify are, they're like, think of a bit like an Amazon, where, most of the shopping you do online these days, you may or may not know it, but there's like Shopify is powering a ton of it, and they power like a ton of brands. And for a long time, they did battle with Amazon as they're, trying to be like the sort of independent, they call themselves like the Rebel Alliance e-commerce platform for people who didn't want to give like the masses data to Bezos's institution and potentially suffer the consequences. And then they flip-flopped quite a bit in the mid-2020s where they were investing in logistics, trying to compete with Amazon. And I think the CEO, Toby Lutke, just realized like it's impossible to compete with Amazon. They just don't,
by
they
logistics,
don't
you mean actually building physical things, right? Like they started, right? Yeah.
Exactly. So they do everything else. They still provide like a logistics capability, but they just don't have that logistics in-house. Now they kind of, they wrap their logistics around, like FedEx and DHL, and they negotiate really good deals with these logistics companies. And actually they even use like Amazon logistics as well. But they don't try and do it themselves. And so I kind of came to the view, well, do they really have a moat anymore? And I was looking at them compared to like tiny companies, but doing the same thing, like BigCommerce, Wix. There's a whole bunch of other like smaller platforms where you can basically build, your storefront. You could have like online sales, manage your inventory, maybe do like invoicing and do your accounts and all that, all the stuff you need to run a business. It seemed to me that there were a whole bunch of options, not just Shopify. And I was like, maybe this is just commoditized. Maybe they don't really have an advantage. Well, in the age of AI getting in the way of everything and disrupting everything, that could still be true, but maybe it's not. So Shopify is back on my radar. And actually kudos to my brother, Matt, who owned Shopify throughout, didn't sell it, and is like still a Shopify shareholder. So Matt, you might have it right, even though I sold out. I'm glad you stuck around. So are you familiar with this term agentic commerce, agentic storefronts? Do you know what this is all about?
No, tell me.
It's kind of my Google thesis actually from last year, which was like, if you want to buy something, let's say today, you want to buy a pair of trainers or a new hat, you might probably go to like Amazon if it's like a commodity type thing, or, if you've got a particular brand you want, you go to that brand's website or you Google it. And that's been the way we've done e-commerce for the last, 20 years or so, post like the .com boom of like, and the crash of like the e-commerce kind of fake out, but now it is real, obviously. That's like an old story. Well, my kind of Google thesis, why search isn't dead and Google isn't dead a year ago, was they've got all this data on you. They know much more about you than you know about yourself. They have one of the world's greatest AI teams like DeepMind and Gemini, I've said all this before. And they're going to bake advertising, which is like the crux of their business, into AI. So if you're having a conversation with Gemini and maybe Gemini is like researching, I don't know, like a new brand of bicycle, you got like a bike behind you, then the advert will get embedded into like the AI conversation, because a particular brand of bicycle manufacturer will have said, okay, we want to hyper target people like Christoph who are in the Austin area. Maybe it's like a niche, bespoke bike manufacturer, and it'll get embedded into like your AI journey. So agentic commerce is just like the final step in that. Not only is like the AI surfacing the advert as part of your conversation with it, it's also making the purchase for you. And at the moment, this is real and happening now. Like, OpenAI have started putting adverts into their search results. Brands are baking like the ability to buy something through AI. But like the very next step in this is you won't even have to ask for it. Like the AI will just know so much about you, stuff will just show up at your door, and you'll probably have the ability to go, oh no, that was a mistake, like return that. And you'll just like drop it back in the postbox and it will go back to where it started. But because the AI knows so much about you, it would literally just be buying stuff for you. You won't even have to think about it. Like, so that's like in my mind, like the logical endpoint of this term zero-click commerce. Basically, like shopping without shopping. Neo, there is no spoon.
Shopping. Right. Interesting. So what is Shopify's moat in this case? Why can't there be a...
So do you buy, I've given you a chance, I've given you like a bit of breathing room to challenge what I just said. Like, it might be a bit dystopian, but does that seem like a reasonable trajectory for like shopping to go, commerce to go?
Yeah.
Okay, right. So if you buy that is the direction of travel, now looping back to Shopify, maybe Shopify are set up to have a moat again and to win again. And this is a little bit, I haven't fully baked these ideas yet. I'm just kind of kicking them around. Like, they're building, I hadn't realized until recently because I started listening to their earnings calls again, and I caught one a couple of weeks ago. They're the ones partnering with Alphabet and a couple of other industry leaders to actually build like the protocols and the infrastructure for agentic commerce. So they're like defining the rails. And if I look at them compared to like a BigCommerce and a Wix, like they are much better positioned to succeed in a world of agentic commerce, because not only have they, okay, it might be a smaller thing that they've actually like defined the protocols and they've built the stuff, they built the railroads, but they do have like a ton more insight and data, and they've already got millions of brands. I think that's true, but a lot of brands on their platform. And, if one thing we know is true, right, is in the world of AI, like ultimately everything gets commoditized. The thing that really has meaningful lasting value is data, is like the information, which is why like Reddit is a bit of a meme stock, because they have a lot of proprietary information, because people write a lot of shit on Reddit and that doesn't appear in other places. So Shopify do have a lot more data than some of these other competitors. I'm not comparing them to an Amazon here, but I am comparing them to like a Wix or a WooCommerce. Yeah. And like, I'm not saying like buy Shopify. I'm not jumping back into this myself right now, because I think that's probably reflected in the relative valuations of these companies. Like Shopify is a beast compared to these other minnows. Yeah, Shopify is a beast. Like it's $160 billion enterprise value today. And the other guys are like, Wix is like a $4 billion company. BigCommerce is like a $260 million company. Like these, you can't compare these in any way. But maybe Shopify do have an in here to like have a material moat.
I don't know if this is the right question to ask, Badge, but right now I see like a dividing line between the companies that will be enabled and take advantage of the AI acceleration, and those that will be destroyed by it. And for example, in my short bucket list, as per last episode, I have companies like Adobe, Duolingo, and Fiverr. Whereas you're saying Shopify is in the other bucket potentially. And what I'm hearing, I'm trying to discern like, why does one go into one bucket and the other? Obviously, Adobe is also a massively huge company, $108 billion. It seems something to do with network effects. Like that is it like that once you become big enough, then the competition dies out, whereas I don't know, in the case of something like Duolingo, I mean, its revenue is increasing, its users are increasing. Maybe it's a different category problem that we're trying to solve. Maybe Shopify has more of that infrastructure in place. Like, how do you understand the difference between the companies getting killed and those
It's
succeeding?
like how easy would it be to replace? So let's say, I mean, it's a kind of such a weird comparison, but let's just say Duolingo versus Shopify and sort of think about like where they are today. So like I'm a Duolingo user. I'm on like now coming up for 1,200 days streak. Duolingo have never had any money from me. Like I'm a cheap ass. I've literally just used the free plan. And I don't even watch, they screwed up. Like they screwed up. I don't even watch the adverts anymore. I've realized I don't have to watch the ads. I literally just do the lesson and I can just like scroll away from the app and I'll preserve my streak. I don't know why I'm preserving this freaking streak. Who cares? But anyway, my point is more.
Sorry to interrupt you, but you know what Monkey's one mission in Vegas is going to be in a month's time? It's to ply you with so many banana daiquiris that you will forget to turn on your Duolingo streak.
You get streak freezes. Anyway, let's not go there. Like my main point was going to be, if someone like gave me like a different app that was just a tiny bit better than Duolingo and maybe a bit less annoying, and I felt I was learning language from it, I would just switch over, right? There's no switching cost from Duolingo, apart from the streak, which I kind of don't really care about. And I almost use as like a bragging metric as to why it's such a bad company, because, well, I don't know, that's a bit counterintuitive. Anyway, whatever. There's no switching costs. And something like a Shopify, the switching costs are quite high. They're not saying they're insurmountable, but they're quite high. If you're like Nike or one of these other brands and you've partnered deeply with Shopify to manage your inventory and your storefront and everything else, like it's pretty deeply plugged into your business. And yeah, sure, you could vibe code and build like your own e-commerce platform or switch over to like a Wix or a WooCommerce. But it's going to be harder to do that. There might be some customer impact. And you know, there we're bearing in mind who is the customer of these companies. Like the customer of Shopify is not the end, like the buyer, like me buying a pair of trainers online. The customer is the brand that has like integrated their back end.
So something about deep integration into ecosystems versus a more surfacey level service that's being provided that in the end can become white labeled.
And there's I would say go back and listen to that episode that you and I did over a year ago with Matt Cochran, when we talked about moats. Like there is like the other aspect of moat Shopify has is like I said, the data, right? You know, if you may not know it, but probably a decent percentage of the stuff you buy online is powered by Shopify. And they know that that's Christoph under every transaction, even though you don't know it's Shopify behind all these transactions. And if you bought like a new bike, then your Shopify are going to act to, you know, use that information and possibly like sell you a bicycle helmet and, you know, like some inner tubes and whatever other stuff you might want as a bicycle owner. And they have that information. Like Adobe and Duolingo, they don't have those levers, right? You start making, you know, you like our Patreon who gave us his portfolio to review, and my colleagues are using Adobe. Well, if someone gave them like a better version of PowerPoint or PDF, or their company said, okay, you know, we got this, like, you know, we're going to move to Google Suite rather than Microsoft Office or whatever. Like, just switch over. Who cares, right? You know, it's not like you have all this embedded stuff and you have to, you know, you might have to rebuild your slide decks, but that's not really a serious moat.
Which do you buy first and why? Maybe we leave that as an open question. I mean, obviously valuation comes into like big time, but I'm still not quite clear for myself, given the strength I see of owning the physical infrastructure that is now insurmountable. why I would buy something like Shopify ahead of Amazon.
Oh, I certainly wouldn't, like 100%. Matt Cochran and I used to kind of do battle when we were both at Seven Investing years ago, and he was the Amazon bull and I was the Shopify bull. He was right. Yeah, unequivocally, Amazon is the stronger, the better investment.
All right. Thanks, Badge. Do you want to take a hard pivot to biotech?
Yeah, you've made a beautiful infographic for us. I'm keen to understand what this is all about.
I have one task for myself, Badge, which is to not use any jargon, because biotechs are notorious for, even in their own slide decks, every other word is an acronym and nobody outside the field can understand what the hell any of it is. So I'm going to use deliberately generic words to try to just give you the big picture here. And I think because I'm quite deep into this at the moment, if our listeners, patrons, YouTubers would like an actual deep dive from us, then I think I'm prepared to do one. And that would be, on like going over 15 slides in a much more sophisticated way. So let us know in the Patreons and in the YouTube comments if that would be something you'd want. But here's the big picture. Nektar is a promising promising biotech, not promising biotech. They have currently in development a promising drug called Rezpeg. What's it solve? A lot of people, Badge, have issues with skin inflammation. It's actually, according to many estimates, a truly, truly enormous market. We're talking about, I think, up to 100 million people, or, I mean, it's just, whatever the actual number, it's a lot. And there's a huge amount of money at stake. Within that whole market segment, there's essentially the first line of drugs that doctors prescribe. The problem is it's not that effective, or it's not that effective for about 50% of people. And the longer they're on it, the more the skin condition comes back. Rezpeg has a profile right now in phase 2 of testing, phase 3 being the final, that has basically chef's kiss numbers in terms of safety and in terms of efficacy after that first line has proven ineffective. So this is a misunderstanding. They're not going after, say, that first line. They're going after the 50% that the first line doesn't quite work. And because it's such a massive, massive market, maybe one of the, I don't know if it's the, but potentially one of the biggest drugs biggest drug markets possible. This is a huge opportunity. And so recently data came back and proved that for now, at this phase, this particular drug would wipe the slate clean for all the competitors in that second line. And the stock basically rallied quite a bit on this news. That itself would be worth investing in. We've got a timeline of about next 6 months, a year, in which more of the data will show up. And if it continues at what we have now, it's going to be a gangbuster drug. That's step 1. Step 2 in this Thesis badge is that there's also built into this a basic call option in that this drug also works for people with a disease that makes them lose their hair in spots. And the TAM for being effective in that market would be something around $1 billion in revenue for that indication. Now, here's the curious thing. In December, data came back, and it was, for simplicity's sake, slightly subpar. But turns out the reason it was slightly subpar was that some people in the trials should not have been in the trials. So it was kind of statistically wonky. That's part 1. And part two is it turns out for hair to regrow takes weeks for the drug to work on the inflammation cells, the T regulatory cells. And it's basically not that you take the pill and then 3 days later you have hair growing out of your head. It's going to take weeks and weeks for your system to realign. The trials basically cut off right at the inflection point where the hair growth would have started growing. The market had a tizzy, sold off the stock by 30-something% based on these slightly underwhelming data. Anybody that knows what they're talking about says that's foolishness. Let the drug work longer.
Quick sort of sidebar, like why did they have such a flawed trial design?
Good question. Why the people that shouldn't have been invited into it? I mean, who knows? That might have been bureaucrat error. That's the best explanation. As far as why the cutoff for that date, maybe a basic misunderstanding that, I mean, the market, in these issues of biotech reacts on the algos, right? The algos see data came in 2% below threshold, sell. Whereas all the scientists know, well, we're giving you the data at this time point, but we really need to look another, let's say, 20 weeks out. So it's kind of knee-jerk stuff. And so this is why when you combine both of these indications, you have best in class in one and misunderstood results in another. And together, this could be massive billions of dollars of revenue if trajectory continues. Well, lo and behold, Badge, at the moment, even with the bounce from the latest results that were really good, this is only trading at an enterprise value of 1.5 billion. Why do I talk about enterprise value? Because they also have 760 million in cash. So it's really, really safe with about 140 million per year in cash burn. So we're going to get through all of the next phases and clinical studies, no problem, no dilution. It's cash rich. And so these are the kinds of situations that I absolutely love, where I have a very clear reason why it's undervalued, catalysts coming up, cash rich, and the data is the data. This will be a superior product. And so Monkey is really, really interested in starting position in this. Let us know if you want to go into the deeper weeds with the actual names of the diseases and how this stuff works. But did that satisfy kind of the big picture without getting into too many of the acronyms?
Yeah, it's good. I feel like I've got like the 2-sentence understanding of what the company is. I'd like to hear more. I stay away from biotech. And it's not the kind of stuff I'd have in my main portfolio, but your hit rate with some of these like micro cap and small cap companies is pretty astounding, to be quite honest. That's how you generated like a 370% return in last year's King of the Jungle Challenge. So yeah, I mean, this has got, based on what you've said, this has got all the markers of like another potential, like Christoph knocking it out of the park.
Yeah, and you know what, Badge? In the end, it ends up being all about the data and, so forth. But I will say this. In this moment of the market volatility and instability, one path, to go back to what we were talking about early in the episode, I might say, okay, I have extra bananas. Maybe I want to open a position in CrowdStrike again. Yes. But also, I love it when an entire sector has been out of favor for a long time and the valuations are just stupid cheap. So that margin of safety is just much higher, I think, in general. It's hard to generalize, but in general, in biotech right now, than in all these other AI, God only knows what's going to happen in that world. So sector-wise, I love being able to confidently invest in a company that is just not loved temporarily in biotech.
Yeah, so like using some of my nascent options university knowledge from attending the last 2 cohorts, presumably this is like a highly volatile stock. So we probably want to be selling options rather than buying options. And I guess there's a date on this because, and you want a date with options, you want to know something's going to happen. You have like a catalyst, which is perhaps when you think the real results post-trial might come in and the market might like realign back to the actual results if you believe they're delayed. And I guess if you're bullish on this, you want to be selling puts. Have I gone down a completely the wrong direction with that?
No, there are, though this does take it. This would end up being a long options lesson. I would put 7 asterisks next to a couple of the things you said. One of the most sort of difficult ways to use options is with biotech. Because remember, in biotech, the results are sort of binary. If, let's say the data comes in 6 months and the drug is obviously best in class, that stock could jump, I don't know, 80%, 90%, 140%, like overnight. If you sold options on that, you're screwed. Biotech is more...
If you're selling puts, though, is that not a bullish thing to do?
Oh, if you sold puts, right, you would gain that premium because it never dropped below the price, but you're not really gaining all of the massive wins from that binary outcome. So I would not actually think of selling options in this case. In cases like this, you would more or less bet on the catalyst making good. Honestly, that's the most direct path, but it's dangerous. And so you would have to earmark enough safety to say, okay, if it goes to 0, it's fine. Or you date them quite far away.
Okay, all right. So this is then part of the options university that I haven't got to yet because I've stuck at the absolute beginner level of just like buy or sell a call or put and nothing more complex than that. But you've got, 50 plus 99 different trading strategies. So presumably there is some combination of things where you buy something and sell something else, and then you're going to get the upside and like mitigate the downside. Is that the real answer?
Yeah, that's right. The lesson here is you need to buckle in and start getting yourself educated using the Wall Street Wildlife University. There's lots of ways to play this. Yeah.
Great. Well, anyway, not financial advice. Certainly do not try and follow my options strategies because I haven't got a freaking clue. And if you do want to know more about Nektar Therapeutics, then drop us a message on the Patreon or on the YouTubes or on the X's. And Christoph is doing the work for his own portfolio, but maybe he'll be kind enough to give us a deep dive on a future episode.
Awesome, Badge. This takes us home, right?
Pretty much. I mean,
you want to mention our partners, Fiscal AI?
No, you did such a beautiful job last week. You did.
So yeah, let's thank Fiscal AI, our essential stock research platform. Luke and I use this every day. It's where we go to start our research process, honestly. And they have all the data from 20 years collected, all kinds of KPIs, all kinds of customizations, earnings call transcripts, research reports. Use our fiscal.ai/wildlife code for 2 free weeks of Fiscal Pro, no credit card needed, and a 15% discount if you upgrade. That's fiscal.ai/wildlife. You are not a serious investor without it. Are you, Badge, a serious investor?
I am a serious investor, Christoph. Are you a beast of an investor?
My journey started here a long time ago. Rawr.
A reminder that the people on this program may hold positions in the companies that are mentioned. Buying and selling stock carries financial risk, which could include loss of capital. The views in this program should not be taken as personalized advice. Before acting on any of the information provided, listeners are encouraged to consult a financial or tax professional.